Hey, Lauren, you want to be in my video? You're in it. Okay. Hey, everyone, me, Kevin here. So obviously we're back to sort of disaster mode, especially since it sort of feels like Netflix might be that harbinger again of disaster. Remember Q1, Netflix started earnings off and everything was a disaster looking towards Q4 earnings, which reporting Q1, and it was a total crap show. Now, I have to say, I'm glad I never invested in Netflix, but my heart goes out to the people who are now suffering about a 38% drop on the day from Netflix. And so a lot of folks are wondering, Kevin, is now the time to buy the dip on Netflix? What does this mean for the broader market? What did Procter Gamble say today? What are my expectations for Tesla? Am I going to live stream Tesla today? Why? Then I get questions. People are like, Kevin, why isn't your house fancier? It's like, well, because I spend all my money on stocks. But anyway, so let's just go through some of the madness going on today. Mortgage interest rates also hit 5%, which has some implications for some stocks. I actually sold a company that I really, really love. Talk about that here. So let's just get into all this. Keep in mind, we just spent about 50 minutes together with course members answering a lot of questions and brainstorming together, strategizing. It's really fun. So if y'all love it or say something in the comments. If you're not part of it yet, check out that coupon code link down below. It expires today. It's the Tesla or Cyber Kevin coupon code. Yeah, from Giga Rodeo, which I'm still wearing my bracelet from. But anyway, so let's get into this. So Netflix, they were expecting 2.5 million subscribers. And this is such a disaster. They were expecting to lose 1 million from Russia, and they were still expecting 2.5 million of growth. They ended up only losing 700,000 accounts from Russia, only 700,000. But the fact that overall they reported a loss of 200,000 accounts, a company that's a growth company that's contracting, makes a lot of sense in terms of why the company's now dropping like 38% on the day. Now, that doesn't mean we can't get a nice bounce off of this, but look, when a growth company becomes a not growth company, it's a terrible, terrible thing. Even if you take out the Russia loss or you add that back in, so to speak, that would be a gain of 500,000 accounts, which is really just terrible faltering growth. The company is blaming the noise of COVID and the pull forward of demand and account sharing and also competition, which all of those things are terrible for really probably the next year or so at least. Bill Ackman was one of the people who bought January's dip on Netflix, and he probably just lost $400 to $500 million today on that bet, which is just insane. Netflix actually jumped quite a bit after he announced that he was buying the dip, and oops. Anyway, I wanted to talk a little bit about, two things here. One, the account sharing thing, which I actually think is very, very bad, what Netflix is trying to do. And then, number two, I want to talk about would I buy them. So Netflix is doing this thing where they're like, oh, let's try to crack down on account sharing and let's advertise more, which I love hearing, first of all, advertise more because I'm a big fan of investing in companies like Trade Desk, and Trade Desk is one of the few companies that's green today. I just bought a lot more of Trade Desk right at about $60 when it fell just a couple days ago. It's like $70 right now, so I'm really happy about that. That doesn't mean I'm always a winner. I think, who is it? Rana. Shout out to Rana in the course member live stream this morning says they've been tracking all of our trades, and we're at 89% profitability, which honestly in this market, I'll take. So okay, the advertising thing makes sense. Trying to get some more ads in on Netflix, I think that'll be great for advertisers. Probably not so great for Netflix though, because I think they're going to piss off their users. In addition to pissing off their users, I want you to consider this. What happens when people account share? Like, let's say I share my Netflix login with Ross, right? In my opinion, if I share my Netflix account login with Ross Gerber, I believe I become a more sticky member for Netflix. I'm less likely to cancel because I have now given Ross something of value. And if all of a sudden Netflix is like, well, now we're going to charge you for 2 accounts because you're sharing with Ross. We see the different IPs. Like, we're on to you. It's like, okay. Then I might get to that point where it's like, wait a minute. I'm not really watching Netflix anymore anyway. Hey, yo, Ross, are you watching Netflix? No, not really. I don't have time for it anymore. Let's just cancel it. So in my opinion, their attempt at trying to monetize all the account sharing is actually just an opportunity for people to say, yeah, I don't really need Netflix right now anyway. It's almost like a catalyst for people pausing their accounts or canceling their accounts, and then it's like, I'll sign up again in the future if I want to. So I think that's actually a really bad thing, trying to monetize the customer base a lot more. I personally do not believe this is a sign of demand destruction. I think this is a sign of just Netflix destruction. It's a growth company that's no longer a growth company. And so Netflix right now has an EPS of 11, which at the current prices puts them about at a PE ratio of about 20 PE for 2022, which seems really good for a growth company. But they're only projecting to grow revenues at 10% per year for the next 5 years. And I honestly think the expectations, those 10% growth expectations, are going to fall after a report like this. And so that means you're paying a PEG ratio of about 2, which is a little expensive for the growth that you're getting. And that growth is on a downtrend, not an uptrend. That's bad. So for me, even though I think it would be reasonable to assume, hey, buy the dip, YOLO will call option at close, at the closing sell-off, and then, fingers crossed on a big tendy, it's not a company for me. So it's not what I've been interested in, and, maybe if its PEG ratio got down to like 1, but I think even if its PEG ratio were at 1, I still think their growth estimates are going to decline, and they're realistically probably at like a PEG of 3 or 4 right now. It's not great. So for me, Netflix is a no, but that's for me. Now, let's touch on Procter Gamble, because this was interesting, because that question is coming up about consumer demand destruction, and the suits are sort of debating about this on Wall Street, and one of the things that's actually helping give us a little bit more color is Procter Gamble. Just like the banks last week told us that we expect incomes to actually rise this year, we expect bank balances to rise this year, and we expect spending to continue to rise this year, not just because things are more expensive, but because people are willing to pay more. Well, that brings us to Procter Gamble. So Procter Gamble is that company that you probably actually have no idea what Procter Gamble makes, but when I mention the brands that Procter Gamble owns, you'll recognize probably all of them. Let's try. Tide, Cascade, Febreze, Gain, Pampers, Loves, the cheap version of Pampers, Bounty, Charmaine, Tampax, Gillette, Braun. Anyway, I'm sure you've recognized probably 9 out of 10 of those. So they just increased their buybacks, great dividends. I'm not so worried about the exact details of the company. I want to know what they're telling me about for other stocks, right? And to me, they're reiterating why we've been talking on this channel for the last 4 months about this transition away from consumer discretionaries and into consumer staples. Now, I'm not a big fan of buying consumer staples myself, so for me, I've been more of a purchaser of Tesla. But one of the things that I did do over the last few months is I completely sold out of Affirm. I completely sold out of Etsy. I completely sold out of basically any kind of consumer discretionary stock, and I'll even tell you another one that I sold out of towards the end of the video. And I've been increasing my bets on advertising and Tesla. Trade Desk is my advertising play, right? And the reason I'm betting on those rather than going into the staples or the commodities is because I think these are a temporary safe haven, and the staples and commodities will rotate back down, and they're creating buying opportunities in other companies that do actually have serious growth. Trade Desk, Tesla. And I'll talk about Enphase in a bit. But anyway, so it's important to remember, before I talk to you about what was in the earnings call, that if consumers have $100 to spend, you get less product today than you would have. If you could buy, I don't know, I'm just going to make this up, 20 razors with $100, now maybe you're only getting 18, right? That is an example of inflation. Now, if you say, well, I'm going to spend $110 to still get 20 razors, yeah, now you're spending more, but you are making the choice to spend more. So this is a very big misconception when it comes to consumer spending more. If consumers are willing to spend more, that's a good sign. And so the information that we actually got in their earnings call reiterated this. So here you go. Listen to this. So first of all, they expect a margin hit from higher inflation. They're only passing on about 50% of their cost increases to consumers. But listen to this. Quote, shoppers continue to pay for premium items such as fragrance-free diapers and high-end razors despite rising prices. In fact, the Wall Street Journal reported that Procter & Gamble said, quote, the priciest offerings were in highest demand and are still in the highest demand. And they have not seen a trend towards discount products yet. In other words, people who used to be lower income households or are still lower income households switched to premium brands during the pandemic, and then did not switch back to discount products or have not yet switched back to discount products. They still could, right? Procter & Gamble is still planning on hiking prices. Their next big price increases are coming in July, which obviously not good for inflation. That's going to be another inflation issue there. It's one of the reasons, in my opinion, you've got Costco killing it. They've been killing it all year. They're one of the staples that I've regularly been cheering. They're at $600. They just crossed $600. It's really incredible. I mean, they did great during the pandemic, and they're just killing it now. Phenomenal company. But this was interesting. Guess what else Procter & Gamble is spending a lot of money on to convey their innovation and value? Advertising. They are, quote, increasing, this is a paraphrase, it's not a quote. Strong top-line growth in advertising as we continue to communicate the value of Procter & Gamble. Anyway, so inflation costs are, though, broad-based and continue to increase with little sign of near-term relief. That was not good. That was a very, very, very bad line. But the fact that the consumer is still spending is a very good thing. But how long does that last? Well, they actually gave us a little bit of guidance. They said that they expect all of this inflation to be a, quote, temporary bottom line rough patch, that consumers have about 20 to 30% more price elasticity than usual. That's a way of saying that consumers are willing to spend 20 to 30%, or as prices go up, they're losing 20 or 30% fewer customers than they thought they would lose as prices go up. In other words, people are sticking with products and the price increases. They do not expect that elasticity to hold into Q4, though. But right now, they are really branding trade up to Procter & Gamble products, and they want to really advertise that pretty heavily. Kind of interesting. So for me, this is an incredible measure of the consumer. It's basically the consumer saying, hey, no, we're willing to spend on the stuff we want. We still have the money to do it. Again, we don't know how long that'll last. Today we had the yield curve flatten a bit again. We're only at about 28 basis points of a spread. We've got Tesla earnings today. Tesla usually turns red after earnings, but it's already red. You've got Steel Dynamics reporting after the bell today. That'll be huge. Rumors that they're going to be the Cybertruck steel company. They're a Texas company. And they've been killing it as a commodity play, obviously. But, I mean, golly, you look at the market right now, anything stay-at-home related is just getting wrecked. Now, I'm going to talk about real estate and Enphase in just a moment, but, Netflix, 36%, Roblox, 12%, Shopify, 10.5%, Wayfair, 9.6%, Peloton, Enphase, all these companies down 7 to 10%. And to me, it's just, this is a clear sign that anything stay-at-home related is getting smoked. But not just stay-at-home related, anything related, in my opinion, and this is going to come more and more, to the real estate market, I expect also to get hit. So I actually closed my entire Enphase position, which I feel so terrible about because I love Enphase. I was just showing my Tesla, or my Enphase, it's not Tesla, my Enphase battery and solar panels to course members. And I, like I mentioned earlier, I already closed all my Etsy. And the reason for that is as mortgage rates continue to rise, now they're over 5%, I highly anticipate that we are going to see people spend less money on homes and at home. They're going to spend more money on services. We already expect that transition to occur. And as that happens, companies are going to be more inclined to spend more money on advertising. Now, Tesla doesn't advertise. Tesla doesn't need to advertise. So I'm optimistic for Tesla long term. I continue to add to Tesla. And I do expect the stock probably to fall after earnings. And if it goes up, it'll be a nice treat. But advertising, Tesla is where I'm at. If I was going to play commodities and the staples, Costco, Target, Steel Dynamics, the wheat ETF. I've been pitching the wheat ETF since before the war. So, and that's just absolutely killed it. These are some wonderful things if you're looking for sort of that sector diversification. But anyway, if you want to ever ask questions or are curious or you want to have some amazing lecture content that you can sort of watch in the mornings or nights, weekends, whenever you want, or on the go, make sure to check out the programs on Building Your Wealth. You've got that coupon code expiring today. Would love to have you there. And I know you'll learn a lot, whether it's business formation, insurance protection, liability, real estate, longer-term investing. Everything is there for you. It's absolutely wonderful. Property management, you name it. So I think you'll love it. Thanks so much for being here. Good luck out there. Stay strong, and we'll see you in the next one. Goodbye.